Hi there, welcome to our first Voices from the Field session. I'm here at Deloitte in the wonderful Edge building of Deloitte, Netherlands, and I'm here with Koen, and I would like to ask him something about credit risk so that we can really have the professional grasp on that. So my first question for you, Koen, and first of all, welcome. How is the banking sector currently viewing the use of models?
I think banking sector is using models for many different purposes. It can be used for valuation of their assets or their liabilities. It can be used for risk management purposes, doing capital requirement calculations or IFRS calculations. So models are widely used within the banking industry in many different places. Credit risk, the topic of this MOOC, is one of those areas which is quite advanced. It has been the introduction of Basel II really helped the development of credit risk models, and definitely in the risk area the use of credit models is very common. Within Basel you have many different reasons why you want to develop your own models. You have specific rules for capital calculations which really stimulate the use of models for credit risks. So it's a very commonly used and many practitioners and many professionals in the banking industry make use of those models either from development side, model validation side, or they really make use of the outcomes of those models.
And if we focus on the models for credit risk, what do you think are the latest development in their use?
If we think a bit back, Basel II, introduction of those credit risk models and the different methodologies that have been stimulated, we have seen that first most of the banks started with probability of default models, because of course you have a lot of data on that. And then later on they turned into LGD models and exposure at default models. And definitely the last two have been far less developed, I would say, than the probability of default models, which is also a bit the result of the way Basel II was set up. And they have a foundation approach where you really want to model your probabilities of default, but you also have an advanced methodology where you also develop your own LGD and your own exposure at default models. But of course, you can estimate the probability of default from the large sample, the large population that you have, but only your defaulted clients will help you in modeling your LGDs or your exposure rate defaults. So that's of course a much smaller group and it's much more difficult to develop those kind of models. In the past, various supervisors have been performing many studies, but also the IMF, International Monetary Fund, Barclays and the EBA have performed some studies on the outcomes of those models. So they did benchmarking where they really compared for hypothetical portfolios what kind of risk weights have been calculated from the various risk models by the different banks and in the different countries. And they have seen massive differences between those models. And all those models have been developed by good practitioners, have had decent model validation rounds and have all regulators looking at it. And still we see massive differences in outcomes of those models. And that was one of the triggers that also now pushed towards a big revision of this credit risk framework, where the regulators really try to get more in sync figures, and that the outcomes of the various models also are a bit more the same and not a factor of 5 or 6 different, because that would be quite strange if certain client segments are 5 times as risky in one bank than it would be in another bank.
So what do you think is the future of credit risk models in determining, for example, the capital requirements, but also beyond that?
I think for the banks it's really important to be able to use their own models. I think you have a very good understanding of your specific client base, and you also have a very good understanding of the dynamics on your country, on your client base, on the risks in that portfolio. So for a bank itself, I think it's really important to develop these models for yourself and to be able to make your own assessments which client is more vulnerable than other clients. So that's to start with. But also I think for the regulator it's really important to have banks really examining which clients are sensitive for defaults and which clients are not. And by dictating it from a regulator perspective, what kind of risks there is in a portfolio, I think is also quite dangerous, which means that everybody has more or less the same view on the risks. which is probably not the case, and probably it's better to have the own estimates of the banks in there. And I think to a certain extent the regulator also wants you to develop your own models, but I think they want to be much more reluctant in accepting the large differences we talked about a couple of minutes before. I think they really would like you to be able to measure the risks, but within a certain boundary, and that's why you also see that they are looking towards maybe some sort of a floor to the credit risks that you calculate from yourself. But a floor that they can maybe force upon you from their perspective. So I think the internal models will definitely be there. They will be accepted by the regulator. But I think there is much more work to do in getting a more harmonized view within all the different countries on the use of the models. The last step in that, of course, is the model quality review that will be put upon the banks in the coming period, where the different regulators, stimulated by the European Central Bank, will really look at all those models and review what's happening and make sure that the quality of those models is fine. So I think there's a good future for all the model developers, also for the credit risk models. There's definitely a need for those models, and I think also from the regulator it will be accepted.
What do you think about the developments of the internal rating-based approach? So how do you think their future can contribute to have a better credit risk management?
I think there's a big change coming up. I think if you look at the different regulations and the consultation papers that are being issued, there's a big change already from the start of those models. So they're already starting to revise the whole definition of default and giving much more guidance and clarity on how you have to look at that element. And that's of course the basis of credit risk modeling, because we try to model those defaults and we try to model the loss given defaults, etc. So first we have to have a harmonized view on what actually a default is. So that's already a very big change to what we have now. I think there is much more regulation forced upon how you have to look at those default definitions. And I think if we have a much more common view on how to look at that, it's also easier to get a better understanding of the different items that are involved in developing those models. So I think by only that aspect, it's already helping in getting a better risk management. But also on the other hand, if you look at for instance, the low default portfolios, it's quite amazing what we've been developing as model developers for those portfolios. It's portfolios where very little number of defaults have happened, and we've been able to establish all kinds of probability of default and LGD models, which is of course based on limited data. And I think that also drives towards a large variance of outcomes. Because, well, there's a lot of expert judgment involved, there are a lot of many interpretations that you can do. So also the way that we looked at low default portfolios before, that will definitely change going forward. And I think we've been able to develop models out of very little observations. And I also think that the regulator will stimulate the model developers by actually not doing that anymore. If there is no data, then don't try to build very advanced models. If you have a lot of data, I think there's a good way that you can develop models that you can defend well, but with very little data, that's of course very challenging. And by the fact that they are now looking much more critical at those low default portfolios, I think it will also help better risk management. And the third item in there, I think that also everybody needs to be aware what the outcome of a model actually is. It's maybe a way that we can distinguish better clients for worse clients, and we can find out what kind of capital we need. But we have to be really careful in interpreting the figures itself. It's maybe a good starting point for doing risk analysis, change certain settings and see how your portfolio changes. Or if you keep your settings constant and you change your portfolio, what actually happens to your whole credit risk figures. I think that's the way that you have to look at models as well. So not purely the strict outcomes, but definitely how they change over time and over portfolios.
Yeah, I like these points because as we have already seen in the course, actually the probability of default is really dependent on your definition of default. You want to study the probability of something, and necessarily that probability depends on what is the event you are dealing with. And I also like your comment about the fact that we can have very fancy, fantastic models, very advanced, but if we don't have the data, probably it's better to be a little bit more humble and to deal with something that we can really trust instead of something which is on paper very nice but then difficult to apply because we are lacking the data. Also taking into consideration the last moves of the Basel Committee on banking supervision, do you think that we are moving towards a less model-based credit risk management?
I think it's a very difficult question to answer, either with yes or no. I think there will, as we said before, there will always be models involved because you have to develop a way to measure risks. And so you definitely need the models to be able to do so. But I think the very difficult part is to what extent will we indeed allow models to be very advanced, like the low default portfolios or the way that we would accept variances in outcomes. And I think that will be much more limited. And that of course can also put a big challenge on developing those advanced models. If we have a floor in your models and that floor is actually quite high to a standardized approach that would be prescribed, how much of the benefit would you gain by developing the models yourself? If you cannot gain a lot of benefit in terms of capital, then what's then actually the reason why you want to develop such an advanced model? You can of course do that still for your own purpose, for your own sake, because let's say from risk management perspective, you want to be able to still distinguish the better from the worse and get a better view of which clients you want to accept or which clients you don't want to accept in your portfolio. But then it's far less from a regulatory perspective and much more from a business perspective. And I think that's definitely a threat to the advanced modeling that we're doing, because if there's no capital gain, well, then there should be a strong risk incentive, of course. But the question is always whether that will be enough to get senior management stimulating you in developing those models. So there's definitely a big risk, I think, in this capital floor.
To what extent are measurement approaches aligned in regulation and accounting? What do you think about that?
Well, I think they are not aligned, definitely not to the full extent. It would of course be very nice if they were completely aligned, but at the same time they're also there for different purposes. If we think a bit about what your capital is telling you, it's also the way the buffer that actually you need to cover up for losses that might happen over a longer period. Whereas the IFRS calculations are much more focused on the figures that we actually need today. So what's the balance sheet of today looking like? And that also is a bit reflected in the way it's measured. So the IFRS calculation is much more based on point in time, so what's actually today's world. Whereas for the Basel calculations, we are more based on a through the cycle approach. And that's of course difficult by nature, but it's also putting an extra burden to the model developers where they need to be able to do both. Also, whereas the IFRS, the provision calculations are based on the expected losses, well, your capital is much more based on your unexpected losses. So it's a different purpose and it's a different calculation. So we definitely see that over the last period, the regulator and the accountants have been talking to each other, but they did not really find common ground completely to the way that they want to look at those risks. But I think there are good reasons for that. It definitely makes life difficult, and I think also for the model developers it makes life difficult, and for the users of course it's difficult because you see different figures in various reports at various different occasions that you have to look at those, and it's not always in line how they move or how they change or what the impact would be. So that's, if you talk about can we rely the models, well, it's difficult if we see all those kinds of different outcomes for more or less the same risks that we see. So we have to be able to not only develop good models, but definitely we have to be able to explain really good to our users what those models are like and why they are different, and why it's actually not a big problem that they're different. So I wish they would be more aligned, but no, unfortunately I think they're not.
Okay, so you agree, probably you agree with me on the fact that there are still a lot of open questions, of open problems, and this is also something nice because it's a lot of possibility to work on and to really show that this field of research and of work in the profession is really an interesting one that gives us the possibility of seeing very different topics from very different point of view, always under a common panorama, which is the one related to the fact that we are dealing with credit risk.
Absolutely, I fully agree. I think maybe a couple of years ago we thought the field of credit risk was more or less
mature.
Done. It was mature and we already know how to model the different things. But with all the upcoming changes, I think it's a field where a lot will happen in the coming years, and it will be very interesting for all the practitioners to develop their skill set in this. Yeah.
Okay, so I want to really thank you for being here with us, for contributing to the course with your insight, your professional insight in the field, and I'm essentially saying hello to all of you. See you in the next classes. See you in the next session of Voices from the Field. So, goodbye.